G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers. I'm here with Owen Rask from the Rask mighty conglomerate down in Melbourne. You've got the vest on. A cold morning in Melbourne today?
Beautiful morning, a little bit chilly, but it is warming up, Pete, so pretty happy about that.
Yeah, grand final's only just a tantalising couple of weeks away now, and I will be in town for that. So, yeah, looking forward to catching up. I'll definitely pack a jumper. What's news in the world of Rask and Melbourne this week?
Really not too much. I had a good hearty debate with someone about office property not being crash hot in Melbourne at the moment. Like, we're looking for office space and a lot of vacancy. But other than that, in Rask more broadly, I was just telling you off air that we're super under the pump in our financial planning business. In fact, across most parts of our business, a lot of people wanting to invest. We have an investment platform for people that don't know, like we can invest in the same strategies that we follow for our financial planning clients. You can follow just as an investor and let us manage your portfolio. And that's busy. And then also their financial advice is just incredibly busy. Like I told you, we had to turn off our funnels for a while because it was just too much. We just couldn't keep up. So good problems to have. But how about you, mate?
Well, it feels, doesn't it, like people are getting set for a new cycle. Similar kind of issues, really. In the property world, it's very, very tight buying conditions. Not everywhere in the country, but if you look at listings in Perth are the lowest they've ever been, lowest on record practically. Brisbane, if you want to buy something half decent, it's really difficult. I would actually read out what one of my buyer's agents said the conditions are like in Brisbane, but we'd probably have to bleep it out on the YouTube recording. Not much fun, I guess, would be the polite way of putting it. So yeah, it hasn't been much fun for our agents of late. Been missing out on a few properties, which is quite disheartening because you go through the due diligence to buy a property, and don't forget, in real estate world, you've got to potentially go through building and pest inspection, quite apart from all the other due diligence, getting solicitors to research contracts, and you're looking for nearby DAs and all the bits and pieces of due diligence, and then get a couple of bidders come along and outbid you, and then you're back to square one effectively. So yeah, there's been plenty of that going on recently. So yeah, very challenging. If you look at all of the media headlines this week, it's all about auction fever, extremely tight rental markets, prices surging. That's the kind of general vibe out there. I think just sort of zooming out from real estate, we were talking about the immigration debate only last week on 2 Cents, and of course it's been all over the news this week with a sort of anti-immigration. I don't know if that's the right way to phrase it, but it's sort of immigration-related rallies in Australia. It's been exactly the same in Europe. So, yeah, I guess that's an issue sort of globally at the moment. I think my sort of general experience has been that Australia actually has a much better system of immigration than many countries in Europe do. I mean, obviously using the word better in sort of scare quotes, if you like. But in Europe, a lot of the sort of the protests have been around sort of illegal or irregular migration. In Australia, it's just the numbers that are really causing an issue because, it's kind of wild reading some of the debate online because anyone who sort of expresses concerns about the level of immigration is immediately accused of being xenophobic or anti-immigration. But I think if you try and take a more sort of sanguine view, I mean, we know that, you can't bring in 1 billion people into a country. So almost by definition, there's an optimum level of immigration. I think the sort of net overseas migration target will be set at around 185k. Then you've got the temporary visas component and the natural growth of the population. But we've just been running above that level on the COVID reopening. And of course, as everyone's experiencing shortages of things like rental properties. And that's been a big driver of this. We've had issues with tent cities and record low rental vacancies. And I guess that's kind of sparked things off a little bit. So yeah, that's all been in the news this week, as you would have seen, no doubt.
I remember about maybe 2 or 3 years ago here on the Property Podcast, early days, I remember Chris saying something. He's like, this supply-demand imbalance in a property has a genuine potential to lead to some social unrest. And we all kind of knew that was coming, but he called it out pretty clearly. And I think while there's so many other issues that are going on with him, well, it's pretty good employment right now, so we're lucky about that. But there's a lot of other issues going on in society. But for housing, I think that housing in particular is where that issue rears its head a bit, quite a bit more, and because it's real, because people have to have somewhere to live. And as we've spoken about, I think the past 2 weeks now, there was that issue with like the ABS seeming to want to stop reporting on certain information, which is a bit of a real red flag for anyone. And I think maybe that's part of the reason, right? Is we saw that come into play. But broadly speaking, Pete, I guess when you think about it, we've seen a lot of, obviously post-COVID, we saw a massive drop in immigration, and then during the lead up to the election, there was a lot of talk about. Then we saw the snap back. But then there was, in the lead up to the election, there was a lot of talk about, well, we're going to have to ride through this bump where we kind of adjust to the normal rate. Do you think that's a fair kind of characterization of where we're at, like adjusting now?
Oh, I think that's exactly what's happened. I think, and it's not just Australia. Canada went through exactly the same issues. New Zealand, maybe to a lesser degree. I think what's been slightly different is that in a lot of those other countries, the unemployment rate has started to rise, and therefore immigration naturally slows. People are less keen to move somewhere if the employment isn't available. And in fact, in Canada's case, they're really having to wind back on the immigration settings because it's caused a lot of challenges there. But in Australia, I guess we've got a relatively low sort of government debt ratio, if you look at it versus GDP. The government has really kept jobs growth pumping along. We've got relatively high spending compared to recent history anyway. And a lot of the jobs that have been created have been sort of in the non-market sector. So not just civil service, just a lot of sort of public sector or sort of not private sector roles. That's where the growth has all been. And it's just kept the unemployment rate low here. And as you said, maybe in the past 6 months, there's a sense that instead of normalizing, immigration might just have picked up again. And yeah, I think, as you say, I mean, people will put up with a lot of challenges. I mean, cost of living, difficulties in traffic. But if people can't find somewhere to live, that's right at the pointy end of what people will be putting up with. And yeah, I mean, I guess being a Sunshine Coast resident, you see this firsthand. If you go on the community notice board, not a day goes by without somebody saying, thinking of moving to Noosa or Sunshine Coast. This is my budget. This is what I'm looking for. And the comments are just like, don't come. There is nowhere to live, and it's a real issue, and the Sunshine Coast is particularly acute because of the supply is so constrained, but it's not the only part of the country where it's an issue. So I do think, as we touched on last week, this will normalise. We'll get construction happening again, as we'll talk about in our sort of 3 big news stories this week, and eventually migration figures will normalise. But in the meantime, it seems to be getting worse before it gets better, and that's what's causing so much tension. Yeah,
it is, and hopefully the tension subsides. Like hopefully, like I always kind of think optimistically that this too shall pass, and I think it will pass, and we'll be able to reach some sort of calm there, and I'm really looking forward to that. But we do have 3 big stories. One of them relates kind of in a way to this, which we might talk about. We've got the first home buyer scheme. We've got home values fastest rise in 15 months, and rethinking the housing pipeline. So there's a lot to cover.
Yeah, well, let's do it. So if you're not familiar, our weekly 2 cent segment every Sunday morning at 7 a.m. We just go through the big 3 property news stories of the week. But stick around to the end because we also have time to cover some of your questions in our listener Q&A. So first story this week relates to the first home buyer scheme and sort of early signs of things moving. I mean, I'd already touched on our buyer's agents reporting just really difficult buying conditions. So there's not a great deal of quality stock out there, and there's plenty of buyers around already. The Reserve Bank's financial aggregates figures, which are released at the end of each month, suggested that actually, if you look at the credit growth in the housing market now, it's actually being driven by investors more so than home buyers. Credit growth for investors is actually at 10-year highs. So I think that sort of reflects very low rental vacancy rates and also interest rates coming back down now. So, but yeah, I guess, just chatting to mortgage brokers, at this stage, it sounds like we're just getting a lot of indications of inquiry for first home buyers with relation to the 5% deposit scheme. But it doesn't actually kick in until the 1st of October. So at this stage, we saw the Housing Australia website crashed within moments of the announcement going out there. So clearly a lot of people are being sparked into action. But at this stage, nobody's really processing mortgages. It's still sort of early days. Treasury has put out some modelling which suggests the impact of the scheme would be just a 0.5% increase to prices. So basically nothing, doesn't move the dial. Look, there's been plenty of feedback on that, shall we say, from economists and online commentators saying, well, come on, if you give people 5% deposits, it's going to move prices more than that. I think possibly there's a short-term versus medium-term impact here, because for sentiment, I think it does boost sentiment. It gets people buying, gives you that sense of FOMO. But I think as well, though, first home buyers don't have massive borrowing capacity typically. And also this in time will sort of bring more construction and dwelling supply. So yeah, maybe over the medium term, it's not so off the mark, but it does feel like the dynamic at the moment is there's a general sort of shift towards more urgency for buyers, and that the 5% deposit scheme is obviously a driver of that. APRA is already talking about having lenders on notice for macro-prudential measures. So if they need to cap investor loans or interest-only loans, they may do so if the cycle gets too hot. Yeah, so it's interesting because we talked previously about the 3 percentage points lending assessment buffer. Well, that's staying in place. APRA advised this week by the Council of Financial Regulators, but also there's sort of talk about macro-prudential measures if they are needed. So if things get overheated, particularly for things like investor loans or interest-only loans, then there could be some clamping down from APRA.
That's I didn't really appreciate that context. I really like this quote from Chris Richardson, which was, I'll come back to the medium term thing in a sec, but I'll quote, so a 0.5% increase in the total value of housing, the number is skewed to the top end, is consistent with cheaper houses seeing price increases of around 3%. Right, it's a 0.5% increase in total value of housing, but it'll go up 3%. For those wannabe first home buyers benefiting from the saving of avoiding lenders' mortgage insurance, they're saving around 3%. In other words, the official advice from Treasury is consistent with young people actually being no better off at all. So who does win? An increase of 0.5% in average home prices is a lift in the value of housing of around $60 billion. And all of that goes to the older and richer people who currently own that housing. I mean, that seems like a shorter term shot in the arm. But then with your comment around medium term, I was thinking about this. Is because property is really like supply inelastic, right? Like the demand is there, but the supply is not. So effectively, the short-term impact, as I think we spoke about last week, is move the floor on the first home buyer stock, like property, higher. And then at new normal?
Yeah, look, I could be completely wrong on this, full disclaimer, but my gut feel is we're moving into the spring selling season with interest rates going down and now an accelerated 5% deposit scheme. My guess is we'll start to see headlines about investors battling first home buyers for the same properties, because a lot of investors tend to like that lower price property, better rental yields. Of course, first home buyers are generally looking in the bottom quartile of the market, I would say, if you think about their constrained borrowing capacity. So there's that part of the market is going to see a lot of competition. So yeah, and as you say, it may be that the first people to get in under the deposit guarantee are the winners, but if you leave it 6 months, 12 months, aren't you just paying more potentially? In which case, yes, you might put down a lower deposit, but the cost is you're basically paying more for the same or equivalent property. So yeah, I think there's a lot not to like about it. I think Cameron Cusher said last week, it's good politics, bad economics. I mean, yeah, to be honest, it kind of is that. It's not really it's a band-aid solution. in the short term, but it doesn't really change the dynamic of what's happening between supply and demand. I think actually maybe our third story will come back to this, but it's there's actually a lot of properties under construction at the moment, and approvals are sort of trending higher, but everything is taking so long to build. I think due to things like construction costs and confidence in the market and so on, a lot of developers actually have gone insolvent over the past couple of years, and that hasn't helped either. Anyway, we'll come back to that point anyway in our third story.
One question more on this first topic, which is, I was chatting to some of our team here this week, some of our younger team members who don't own property. And my feedback to them was basically, if you were thinking of buying a property in the next few years, go now to speak to your broker and figure out what your borrowing power is, because if you wait from now until 3 years, my very strong gut feel is prices are going to accelerate in that part of the market. Now, this is obviously me being a bit FOMO, fully get that, but I'm thinking about their best interests too. I'm thinking, if they're saying 6 years of demand is brought forward, unless you're somewhere in that pack near the front, prices are not inelastic, they'll adjust pretty quick, but I feel like if you're a first home buyer listening to this, you've got to be on the front foot. You've got to go and speak to your broker like Chris or whoever you're seeing, because I just feel like this has really broad implications and they'll be pretty ferocious. That's just my gut feel. I don't want to be like alarmist about property, but that's how I'm feeling about this, Pete. I don't know, maybe walk me back off that edge, but I just feel like it's a big move.
It depends a bit where you are. I mean, if I was in Melbourne and I had a 5% deposit good to go, I would definitely use it, because if you look at where unit prices are, they haven't really gone anywhere for a decade, maybe a decade and a half in a lot of cases. I think I talked about this on James Kirby's podcast, the Australian Money Puzzle podcast, a week or two ago. And even in some of those really well-located areas, the unit prices are pretty reasonable. I'd say you're probably buying under replacement cost. Look, it might be different if you're in Perth and the market's completely nuts and it's gone up, best part of a doubling in recent years. Well, yes, maybe the urgency might not be quite the same because, it's expensive and probably getting closer to a cycle peak. So, with the obvious disclaimer that it might depend on where you're at. But for sure, if I was in Victoria, I'd be looking at it, and maybe in some of the regional markets as well.
Mm. Okay, that's good to know. Story number 2, Pete.
Yeah, so, this is just a sort of reporting of what Cotality have said. So they monthly report the sort of housing or home value index, and the fastest home prices in 15 months, an increase of 0.7% in August. So already mentioned the very tight buying conditions. Cotality said stock levels are about 20% below average for this time of year. The home prices actually rose faster in the capital cities, which is the first time in 9 months that has happened, with significant increases in Brisbane, very strong actually in Brisbane, but also Perth, Adelaide, Sydney and Darwin. There was a small decline in Hobart, which has been happening for a bit of a while. So what does that suggest? Well, obviously low stock, but it feels like some of the demand is sort of centralizing again. So even though we talked a lot about the working from home trend, I think a lot of firms are actually sort of trying to sort of guide people back towards the office. It might not be 5 days a week, it might be 2 or 3, but I think a lot of new arrivals to Australia tend to go to the capital cities, and maybe some of the demand is centralized a bit more. So the regions have been stronger over the past year, but just in recent times, it seems that the capital cities are sort of taking over again. I guess a lot of people would have seen Cotality's home value index reported. Over the year, housing prices were up 4.1%, and a clear mismatch between available supply and demonstrated demand, placing, quote, upwards pressure on housing values, said Tim Lawless from Cotality. So, I guess maybe not completely surprising, but maybe this is just what put APRA on notice, because even ahead of anticipated rate cuts and the 5% deposit guarantee, it was the biggest monthly increase that we've seen in quite a long time. And it looks like the capital cities are starting to sort of re-accelerate.
Yeah, it's Quick question for you.
Hmm.
You must know that people at CoreLogic pretty well these days. Why do they rename from CoreLogic to Cotality?
I can't remember. I did actually look it up myself. I assume it was something to do with the parent company, but I actually don't know. I'll have to stick that one into Chat GPT. But
Okay. It's
yeah,
just like it's really cool how they've updated. For anyone that's listening or watching, you can head to cotality.com/au, and it's actually really cool because you can see, for example, over the past year, I can bring this up for people that are watching. The price return of Australian property is 4.1%, but in total return terms, which is also including the income, it jumps to 7.9%, which is really, really good visualization of the data, and it helps you understand the difference between income and growth and that sort of a thing. But I feel like I'm pretty bullish on Australian property writ large, Pete, just simply because, as you say, that it feels like we're in that upcycle, and it feels like if I'm, bringing out my magic wand or crystal ball, and just like guessing, it feels like we're not halfway yet in that kind of upcycle in asset prices. Maybe I'm wrong about that. Maybe we are further along than I am, prognosticating. But I would suggest to people that with rates just coming down, you see an inflection in asset prices as expectations change, not as the data changes. So what I mean by that is, in my experience, when people believe something is going to happen, that's when prices inflect pretty quick. So you see that in the stock market, you see it in bond prices. Like, bond prices are priced off expectations, not the official interest rate. So when we see expectations shift, which I would say we've seen since just before February, pretty dramatically, I would suggest that those macro drivers, Pete, are going to keep pushing house prices together with obviously the government initiatives. But that is my kind of inference of this. I think we're good numbers so far, but I think this is another part of the cycle. That's just my bullish take.
I completely agree. This is why those financial aggregates figures that I mentioned, there's 2.45 trillion of mortgage debt in Australia. Don't forget, we've got a lot of money sitting in offset accounts as well, but also we've got record high cash and deposits on hand. The housing market's worth, let's say, 11.5 trillion. There is trillions and trillions of dollars of equity sitting there, and a lot of wealth in places like Sydney and the eastern suburbs, northern beaches. When expectations change, people say, well, hey, why don't we refinance some properties and buy more properties? That's so there's a lot of time spent from people analysing the market saying, well, look, wages growth has slowed from 3.2% to 3.1%, and therefore the housing market is almost irrelevant, because, as you said, what's going to change things in the short term is going to be expectations, people's willingness to sort of deploy their wealth into property. If they think prices are going up, then they tend to pile in, and that's what drives the cycles. And of course, at some point, the cycle peaks out, and the opposite becomes true, and people are too fearful to buy. But it feels like, if you actually think about where we're at, we've got rental vacancies practically at all-time lows. Stock listings are incredibly tight. It seems as though immigration has picked up again, and it's taking much longer than normal to build property. So all of those things are saying, well, good time to buy. Now, it takes 18 months, maybe it's 2 years, maybe it's longer, but eventually we'll start to see the supply picking up. And at some point, people will say, hang on, these rental yields don't make sense, or I don't want to sort of overpay for this property if we're getting close to a peak, and sentiment will change again. But at the moment, as interest rates come down, if you look at market pricing, they're expected to come down over the next 15 months or so. Well, that's probably going to bring more buyers into the market in the short term.
This is a podcast, or a whole podcast series for another time, Pete. But systemically, because you know a lot more about economics than I do, systemically, do you think assets across the world are going to sustainably get more expensive? And what I mean by that is, like, I look at the stock markets around the world. You look at, like, say, like if you're into stocks, a PE ratio, which compares the price to the yearly profits. We've talked about CAPE ratios and all that stuff before, but like PE ratios get more expensive. Dividend yields are coming down. like structurally. It looks like it's structurally over decades. Property prices going up. Now, this could be a whole money printing, economics debate, but I feel like if you own assets, you are going to get wealthier simply because you own assets and you can hold them. So what I mean by that is if you're in the current setting of our government, of our economics departments, of how we structure society, I feel like across the board, if you own assets, they're like quality assets, they will appreciate for decades to come. That's just my gut feel. It seems like everything is pushing us longer term in that direction. I know this is a podcast for another time, but even though we have those cyclical ups and downs, Pete, I just think that as long as you've got that long-term perspective of property, of shares, or whatever you're focusing on, and you do that prudently, I feel like you're going to be rewarded.
Well, quite timely, because I saw on the squawk boxes when you were probably still asleep overnight, stocks could rally another 50% in 2 years, Bank of America says. So that was reported by Axios on the wires. Maybe they're just trying to hit their bonuses, but yeah, I mean, they may not be wrong. I guess, as you said, there's a lot of fear about money printing, the printing presses starting up again. Just as an aside, I was talking to my wife. She must get bored of me talking about this stuff, but I was saying, if you look at the in the UK, the 30-year gilt yield, so that's what they call the government bonds in the UK, is trading at above 5.7%. That's the highest since 1998. I mean, what's that saying? The markets are basically saying the governments in Europe don't have enough income to sort of cover all these huge liabilities that are coming down the track with aging populations, healthcare, infrastructure. Yeah, and it makes me feel like I would want to have some debt, and I do have some debt in the UK, because it's just going to get inflated away. I just can't see any other outcome. Governments are going to be printing money. They're going to be running inflation above target. And these things in the short term, you don't feel them. The cost of living goes up 5% here or there. But then you look back over 10, 20 years and you can't believe how things used to be so much cheaper. So that's why you don't want to overdo this and get over leveraged. But having some mortgage debt, to me, it makes perfect sense, because if you look at how it gets inflated away. Just as an aside, CoreLogic rebranded as Cotality. This is from artificial intelligence, I should disclose, but in March 2025, reflecting a transformation into a more comprehensive, people-centric property information and analytics provider, combining CoreLogic with Totality. So more data and insights and more connectivity within the property ecosystem. I've got no idea what that means, but it sounds good, and somebody no doubt got paid a lot of money for the rebrand. So
well, it looks good.
Good for them. Yeah, well, that's why they do it and not me. So yes, we've been waffling on way too long. Let's just look at this third story, and we'll do a couple of your listener questions before we wrap up. Rethinking the housing pipeline. So this is actually a piece that Eliza Owen did for Cotality, and also I sort of did my usual monthly update on the building approvals figures in July. So if you look at the data in July, building approvals fell back 22%, but for units and attached dwellings, but they tend to be all over the place. If you get a big project reported in one month and not in another, they're very, very volatile. But actually, if you look at the trend over recent times, well, we've seen about 187,000 dwellings approved over the past year. So we're definitely past the lows of the cycle. And I think if you look at houses, things have been pretty flat really over the past year. But for attached dwellings, they've definitely picked up in Melbourne, Sydney, Brisbane, Perth, Adelaide. So you can see that, it might take 2 or 3 years for that stock to come, but there's enough being approved. Yes, 15,000 in a month doesn't sound like a lot, but actually, as Eliza pointed out in her article, yes, 5-year dwelling completions are actually well down. So what's the balancing figure? It's just taking way longer to build, especially for units. Those projects, normally, we used to sort of think that you could get a unit project out of the ground in maybe 2 years, but everything's taking longer. Things are blowing out. The reasons are basically construction costs, confidence in the market, cost sort of project overruns. A lot of these developments are done on fixed price contracts and they've just overrun massively, and a lot of insolvencies across the sector. So I don't know how that gets fixed and when it gets fixed, but it's not so much that we don't have enough dwellings approved. If you actually look at the pipeline, there's maybe 220,000 dwellings around the country actually under construction, but they're just not getting finished. We're only really finishing sort of 40 to 45,000 a quarter, which is obviously well below what the government would like to see, of around 60,000 to hit the sort of the housing accord target, which nobody believes will be hit.
I thought this phrase, this subheading was quite good. State governments can bring us to water, but markets make us drink. I love that turn of phrase, and it's true, right? Like we'd still got that. Getting a construction business up and running for any of the tradies and builders that listen to this is not easy. It takes a good 3 to 5 years to figure things out, and then get your business underway and start winning clients. Getting supply approvals. It takes time. It takes a long time. So it doesn't surprise me that we've had this huge kind of focus from the political class coming out of the back of COVID when everyone was going bust, and now coming in with higher prices, and it just takes time. It's kind of like the old the snake that's swallowing a pig. It does take a bit of time to pass through, and once it's in, it's feeling good, but we're still not there yet. And so it doesn't surprise me at all, Pete. And if you took a 3-year view, I guess my question to you would be, if you took a 3-year view, you seemed last week to suggest that you're pretty optimistic about supply over a 3-year view.
I think so. I completely forgot to link to it in the notes, but I did see the Australia Institute did a little op-ed over the past week saying the idea that mass immigration is to blame for the housing crisis doesn't stack up when you look at the data. Over the past 20 years, the amount of housing in Australia has actually increased faster than the population has grown, which, it's an interesting point. I think, it obviously depends on the composition of what gets built. In the previous cycle, a lot of what got built was very small high-rise apartments. So the number of dwellings did increase quite significantly, actually, in 2016 and 2017. But what are families really not finding? It's sort of family appropriate housing stock, and it's not as easy to build. A lot of people would say, well, we did it after World War II. We built for massive population growth then, but of course the cities are small. You could build outwards. There was a lot of vacant blocks available. Well, that's not really the case in the areas that people want to live these days, certainly in a place like Sydney. And a lot of the focus with the Productivity Summit will be on things like negative gearing, CGT, concessions, tax reform. But those are difficult things to push through when you've already got a housing crisis. They may be phased in over time, but the timing is difficult, I would say, at the moment, because anything that damages confidence in the development space is just going to add fuel to the fire. So anyway, pretty interesting analysis. We've linked to Elijah's report there in the notes, and you can check it out for yourself. Owen, we've probably got time for a couple of listener questions. Let's read this one from the interestingly named No Idea. I like the moniker. Hello, Pete, Chris and Owen. Firstly, amazing Chris is visiting Liverpool. That's my team also. My question, of course, I know this is not financial advice. I'm in my late 40s. My wife's in her late 30s. We have a property portfolio of approximately 9.5 million with equity of around 6 million. I'm thinking of selling our place of residence and renting instead, which will be around 2 million in cash. Paying down debt would easily be positively geared on the rest of our portfolio. I'm thinking about diversifying into ETFs, bonds or shares. Our combined income is sitting around 700k per year at the moment, and we have a balance of 900k in super. What are your thoughts? Look, a lot of people would say nice problems to have, I guess, and with the obvious financial advice disclaimers here, because I don't know your full circumstances, I would say the first thing to think about is what are your goals? Because for a lot of people, $6 million, if you're renting, it's easily enough to generate a healthy return and start building an income for retirement. And if you're going to do that, you've talked about ETFs, bonds and shares. I mean, look, the simplest approach would be simply sort of choose an asset allocation and just rebalance that for sort of periodically if you want to take the stress out of it. I'd say as a general point, ETFs are probably less stressful than shares if you haven't done much of it previously. I think as well there's some sort of esoteric points, but I mean a big one is like, will you actually be happy renting? A lot of people don't like it, so there's definitely that. But I would say, yeah, my thinking would be if you can gradually rebalance away from that sort of top heavy approach to property into other asset classes, that's probably a good way to go, just because property doesn't tend to be very effective for income, even though it might be more familiar to you. What do you think?
Yeah, I think good answer there. I'll just echo that disclaimer that we don't know your needs, goals, or objectives. That's why the funny name is good, to distance ourselves legally. So, and it's actually, it's going to sound like a pretty crappy answer, but I think this person is the absolute perfect person to get financial advice. And the reason is that once you amass a significant amount of wealth, which this person has definitely done, and absolute respect to them, and they got a fantastic income, 700 grand a year. I mean, that's unreal. Once you get a significant amount of income, incrementally, the decisions that you make have a much more profound impact on how you will ultimately accumulate assets. And so, for example, if you make a 1% difference in your total returns over the next 10 years, which, by the way, most of the time comes through avoiding mistakes rather than achieving greatness, as Charlie Munger would say, like easier to avoid stupidity than it is to seek brilliance. I find that a lot of people, when they get to this stage of their financial life, they're actually still a bit more scarcity mindset. They're still a bit more like, I'll DIY it. I'll find that property myself. I'll go to the bank myself. I'll do all this sort of stuff. When you got this sort of money, get an expert team on your side, a team that you can really trust. And of course, I'm talking my own book here, but I'm talking anyone's book really, is that if I had this amount of money sitting around, I didn't know what to do. You pay a little bit of money for some great financial advice, great tax advice. Incrementally, that could power things drastically forward. So I think they're in a great situation. They also said they had 900K of super, which, I'm constantly worried about the government shifting the goalposts. So I'm always advocating for our clients to build more wealth outside of super, unless they're very close to retirement. So unless they're 5 years out, start building as much wealth outside of super as possible. And that could come in the form of different tax structures. So trusts that might already be in place, investment companies, investment bonds, different, people's names. Could be an elaborate complement of all those things, but just being effective around that. And I would 100% agree with you, Pete. It always starts with goals. What do you want from your money? Because you've got enough to live a life that most people would consider to be excellent. It's just, what do you want in that lifestyle design piece? So great situation. If you want to take that next leg, reach out to some people and get a good team on your side and live the life you want.
Yeah, I'll just echo that, because I know that when I started out, I wanted to do everything myself. And I used to think, well, look, if I make a mistake, I'll own it and move on. But actually, as you said, the further you go down your journey, like I definitely pay for advice these days, because I've got 2 different countries to think about for one thing. So I need tax advice, but also, as you said, just the cost of getting something wrong. And as you said, as you get closer to retirement, you do need to at least think about the options within superannuation as well, because if you could just miss something. So you might not have to pay loads, but just having somebody to get across those key issues might be worthwhile. So before we wrap up, just one other question from Please Explain, not Pauline Hanson. Stamp duty concession for first home buyers. What happens when a couple buys together, but one owns property or has owned property before? Is it half discounted? Or is the whole couple not eligible anymore? Please explain. I think, look, in this case, in Australia, I think stamp duty concessions, they actually vary depending on which state or territory you're in. And I think it can be complicated. I think that where one person has owned property previously, the other hasn't, I think there is an impact, because I think most states require all purchases to meet the first time buyer criteria. So I think, though, some states might allow partial concession depending on the share of the eligible buyers. So I don't think it's automatically hard. So I think the answer is check the rules for your specific state, and if you're not sure, speak to an advisor. But I think these rules are always changing anyway. So what I say even now might have changed by the time you actually get around to making the purchase, because they're constantly a moving feast. So I would say, check with specifically the rules for your state. But I think, I think if one of the party has owned property previously, there could well be an impact, and you do need to check it out.
Yeah, and this is where, if you're not familiar, you can do some great Googling. There are some websites set up that help you understand, and I dare say, like, exploit the opportunities that are available in your state, your profession, the different banks and that sort of stuff. I actually found that, I'm going to talk his book now, but when Chris and Ben from Alcove helped me out, it was probably them that guided me the most in this, Pete, rather than anyone else. Like, they were the ones that kind of said, well, this is you could use this, arrangement for this, but maybe you then sacrifice that in the future. And so just getting that is probably a good bit of advice. And I can tell you, like, when I look at some states and some policies around stamp duty, all of these things, there's different prices for different suburbs. There's, ranges for different states. There's higher stamp duty in some states. So it does vary state by state. When we were buying, this is quite a while ago, our first home, I think it was 750,000 up until that point, and then it kind of progressively faded away. And if you spent 900 grand, you basically get no concession. So there are some rules that aren't necessarily as black and white as well. So definitely get some good advice, or at least do some research on this, because it does impact your cash flow materially. Stamp duty impacts your cash flow. So do some research before you go and bid, that's for sure.
Fantastic. So send in your questions. Chris will be back next week. So you can send in your Q&A, but also join us at the Rask community forum there. It's actually a very good resource if you got questions, or you just want to chat about investing, property, stocks and shares, you name it. So come and join us on the forum. What's news this weekend, Owen? I've just finished a 5-hour tour of the Harry Potter studios at Warner Bros. London. So I've learned more than I ever wanted to know about how movies are made, particularly Harry Potter. So yeah, that's me. What's been news in your world?
Was that the one in Watford? Up the road from...
It's somewhere between Luton and Watford, in a place I've never heard of.
Yeah, it's not too bad. This weekend, I don't think I'm going to be doing too much, mate. I've had a pretty hectic couple of weeks, and we're off to Palm Cove and Port Douglas in a fortnight. So we're up there for 2 weeks, and then down to Sydney for a week. So just a bit of time around the house. It's springtime, so that lawn is growing, mate. So I need to get out there and push that mower around. The Victor's going to get a workout this weekend, I tell you what.
It's a close run thing, but I'd probably go for Port Douglas over Luton most of the time. So I think Australia shades it.
Post-COVID, Port Douglas is back. So get up there, tropical North Queensland if you can. Support those tourism areas. Absolutely wonderful part of the world. So I'm excited.
So good. I'll see you in Melbourne in 2 weeks. And in the meantime, have a great weekend, everyone. And thanks, Owen. Always great to chat.
Thanks. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.